So now that you've learned about investment types, basic investing principles, you're probably wondering about what investments you should own and how much of them. Well, the short answer is that it depends. There's a famous Greek quote that I like, and I've used this multiple times. It is part of step one, is to know yourself, know thyself. And if you like the Matrix movies, if it was on top of the Oracle's kitchen doorway, know thyself. And the reason why that's so important is that every investor needs to keep this in mind since investing success depends on choosing an investment strategy that fits your needs, your personality, and your objectives. All investors are trying to do well. They're all trying to be successful, but each one has different circumstances, goals, and needs. And given that, there are no strategies or investments that are suitable for anyone. One particular example, let's just say there's this great stock. It's like everyone should buy it. But what if you worked for that company? I actually recommend that if you work for that company, you don't have too much of that stock. Why? Because if that company went belly up, not only did you lose a job and your income, but you also lost your investments. Whereas somebody who doesn't work for that company could have it. If a company goes belly up, it has still probably has their own job, depending on how big that company is. But that's kind of what I mean is that every person is different, and that's why there's no cookie cutter solutions. So, what are your investment goals? That's one of the big things I always ask. And as part of your membership, I've kind of given you a couple sheets to start working on your smart investment goals. This is your checklist. It's a very basic one. There are some others that you may want to use out there. The biggest thing is that you just do it. And the reason why is that their studies have shown that people who write down their goals and share it with others to hold accountable are much more likely to reach them. And if only 8% of Americans are reaching their goals, right? Are you one of those 8%? What if one of your goals is to be a millionaire by a certain year, and then by 10 years after that you want to have $5 million? You don't want to be the 92% doesn't meet them. That'd be nice to be the 8% to meet them. Part of it is knowing what your investment goals are. So every investor has to, develop a personal and financial goal that they would like to achieve through saving and investing. The purpose. When you know the aim, the end goal, it's a lot easier to stay on track. These can range from short-term goals like a wedding to long-term goals like retirement, philanthropy, higher education. Once you've got your goals in mind, then that's how you use them to create investment objectives. This is why, and the four-step process, goal setting is near the top, because you don't know how you're going to get to a certain place if you don't know where you're going to go, right? So that's why answers the question, where are you going? And your goals will help. So we use these objectives, these goals that you have, to create the investment strategies as part of the overall financial plan. And generally speaking, investors have a few factors to consider when determining their investment objectives. Wealth preservation, current income, time horizon, and the need for capital appreciation are all factors that should influence investment decisions. Investors should also consider age, financial circumstances, and personal goals. For example, a widow, let's say living off of a retirement portfolio, is going to have very different objectives than a young executive who is still building wealth. So the widow should be concerned about preserving value of her investments, while the executive can afford to be a little bit more aggressive since time is on his or her side. So investment objectives will change over time, and it's important to ensure that the financial strategies are adjusted to keep up with your goals. And the priorities that may shift over time. And we talked about, as part of your membership, your vision, your purpose, right? Some change, some don't. And that's why each of your plans adjust according to what they are. Your personality profile. If you go to artofthinkingsmart.com, there is that little, magnifying glass search. Just type in personality. You could take the personality test that I have on there. And what is your personal style? Because that makes a big difference on how people invest. Some people, I like risk. I'm an entrepreneur. I go out there. If I lose out, but I, made a big splash doing it, I'm okay with that. Some people can't handle any risk at all. They get super nervous. They can't sleep. It really is based on your personality. And as part of your personal style, you have to ask yourself, do you love adrenaline and thrill of risk? Or do you prefer, relaxing in a hammock while enjoying the stability and safety of your backyard? And there is another popular quote about investing that says the key organ for investing is the stomach, not the brain. In other words, you need to be able to sleep at night and feel comfortable with the amount of volatility you can stand to see in your investments. That's why part of the sleep test is one of the tests that I have when it comes to investments. So some people enjoy the thrill of seeking out returns and they can accept the trade-off of greater risks. Other investors prefer a more conservative investment strategy. And as always, no investor is the same and no single strategy will fit everyone, so it's important to develop a strategy that suits your personality. Some factors that affect risk tolerance. So risk in this context is the degree of variability, right? The degree of volatility of going up and down in investment returns or the potential for investment loss that you are willing to accept. What am I willing to accept for this return? A simple question is, would you be willing to lose $5 for the chance of winning $10? Some people, and the other question is, or would you be okay with losing $2, right? But you'll gain $3. Some people will be like, I want the first. The others are like, nah, I don't want the chance of losing 5. I'd rather have the chance of just losing 2 and gaining 3, right? So it really, that your personality and many other factors affect the risk tolerance. So determining your own comfort level with risk is critical to sticking with a long-term investment strategy. Investors who take on too much risk may panic and sell at the wrong time or expose themselves to losses that they cannot afford to make. So putting your goals and personality together can help you figure out your personal tolerance for risk and how you will react to market movement. So, I've included in part of your membership package in the data gathering section, risk assessment, quiz that will help you assess your own risk tolerance. So if you do click on the asset allocation portion, and there's part of the data gathering, there is kind of a little quiz that I give, and for the gold and platinum, I may need a little bit more information depending upon what you are. But but one thing to note is, like, all tools is not perfect. It's a good indicator, and it can be useful to review the worst case returns for asset classes and kind of get an idea of how much money you'd feel comfortable losing if your investments have a bad year or bad series of year, and how much you're willing to risk to get good returns. Other factors that will affect your risk tolerance are time horizon, your future earning capacity. That means, if you're in your 30s and you're in a good paying job and you know that if you do well, you'll continue to make more, you could probably be a little bit more, have a little bit more risk tolerance. And also the presence of other assets like a pension, social security benefits, or inheritance. Heck, if I knew I was inheriting, $10 million, I would be very, very aggressive, right? But I'm not. Chances are you're not either, so that will impact the risk tolerance that you have. So I look at risk. There are many different ways. I'm just giving very brief and just being very generic here. There's 3 types: low, medium, high. And when you are low, you have trouble dealing with any downturn and want consistent returns even if they're low, right? You may have a medium. Large performance swings may keep you up at night, but a moderate amount of fluctuations is okay with you, right? And then high. Even large performance swings won't derail your investment strategy. You're steady as a rock. Be honest with yourself. Sometimes you want to say, I am a high risk guy, I can do this, but really you're not. And when you're lying to yourself or not being honest with yourself, all you're doing is hurting yourself, right? So just be honest. If you medium to low, low, medium, high, invest according to your risk tolerance, because trust me, it'll make a big difference and help you sleep at night. Okay, so this chart here shows you just a relationship between risk and return. And I use this a lot, kind of what we call a efficient market frontier. This is a type of investment strategy that people use. And the bottom line is that the more risk you're willing to take, the further right you're going, the more return that you should expect. And I have analyzed, literally thousands of different types of investment portfolios, and there's a lot out there that they're underneath the line. The line, to be on that line means to be optimal. You can't be above it. You can only be on it or below it. If you're on it, you're optimal. You're as good as you're going to get. If you're below it, you're either taking too much risk for the return that you need, or you're not getting the return that you should be getting with the risk that you're taking. So just kind of think about that. The further right I go, the higher up I should expect. The further left I go, the lower I'm going to expect. And that's important to know too, because if you're in a situation where you need to take some more risk in order to get the return that you need, but you don't want to take it, you have to seriously consider that decision, because over the long haul, you may need that higher return. And the reason I say that is I know some people who just shove money in their bank account. They don't want to do anything with it because they're too scared of what the market's going to do. But the problem is that if inflation's, again, let's say it goes up to 4 or 5%, right? With all the money that the Fed has pumped into the economy, if you just shove in the mattress and then 10 years later, it's going to be worth only half that. That's why it's so important that you look at taking some sort of risk in order to make money. And that's one of the few ways you can do it. Now, the more money you have, the more you're able to juggle that risk. So again, just be careful on kind of not taking too much risk or taking too much risk. You want to take the right amount for what you need on your returns. And it's a personal decision. That's the thing, right? The right amount of risk for you is totally different from somebody else. The right amount of risk for me, I'm almost on the right. Sometimes I fall off the right on this one, but the right amount is almost on the left, all the way to the left. So again, just be very cognizant of what strategy that you're going to follow. Okay, so we covered in this video series of Investing 101 an introduction of what is investing, why do we invest, and who invests. Why do we invest is because it's our money working for us. We're trading money for more money, not time for more money. Who should invest? Everyone should invest, right? And why do we need to invest? Because we need to reach our financial goals. It's one of the best ways to beat down inflation and build wealth and financial freedom over the long haul. We talked about basic investment types. We talked about the stocks. We talked about bonds, annuities, alternative investments. We looked at ETFs and mutual funds as some investment vehicles. Basic investing principles. We really looked at risk and return. We looked about emotional investing, being disciplined. We learned about making sure that we understand relationships between different types of strategies and how some may work for you, some do not. We looked at asset allocation, diversification, some of them. This video, we looked at knowing yourself and your goals, your personality, your personal SMART goals, right? And then also your risk tolerance. For the conclusions and next step, just gonna do a wrap. Share what you've learned with spouses and loved ones. Really, that's an important thing, because the more people make smarter financial decisions, the better off our community is going to be. 2008 happened not just because the banks and some people on Wall Street really didn't do things that were reputable and ethical, but us as on being Main Street didn't also make the best decisions of trying to keep up with the Joneses and buying more than we could afford. But the smarter we can make decisions, then 2008 would not have been that bad. Invest regularly. You're going to have to do it. Save regularly as well, especially we don't know if Social Security will going to be there. Dollar cost averaging, we talked about that as one good way of being disciplined. Avoid investing mistakes, and primarily the primary driver of mistakes is emotions. Be disciplined. And make sure that you look at advice from professionals. If you're a member, I'll be helping you out personally in many cases. Use the forum to work with others that we have on here. Seek professional advice. I'll be glad to help out as if you're a member, and even for my clients, I always help them out too. And even if you're not, I still want to help people, again, because I want them to make smarter financial decisions. And of course, if you have a personal advisor, That's good. I want to say one thing about seeking professional advice. Find out what type of advisor they are, because there's two main categories, and I'll wrap it up into three when we look at insurance. So you have people who just sell insurance. Their job is to sell you different insurance products. They make money only when they sell. It's a commission product. There's brokers who are very similar in the fact that they sell stocks, mutual funds, and they get a commission off of it, a transaction fee. They only make money when they sell something. The problem with those two, and it's not all bad, but there is one problem, is that it could be a conflict of interest. What if I'm selling you this insurance product or this mutual fund, but it's not necessarily best for you, but I need you to buy it because I get a commission, right? It's suitable for you, but is it fiduciary, meaning is it in your best interest? There's also another type of advisor called an RIA, Registered Investment Advisor. That is what my firm, WealthBridge, is. I used to be a broker, but I moved over to being RIA. I like this model where we take no commissions, so there's no conflict of interest. What we do is that we get a fee, just a set fee. Either it's a percentage under management, like a 1% fee. It could be just by hour, pay us, we'll give you the best advice. And if we do take a commission on certain things that we cannot take a regular fee on, we disclose it. So that's kind of the differences. So when you seek professional advice, ask that question: how do they get paid? Because a lot of their advice will be based upon how they get paid. I may give you the advice saying, be diversified, have a good asset allocation, and rebalance. Somebody else say, you need to buy this investment product. Oh, and by the way, I'll get a nice commission because you'll do it. So that's why the advice can be very different. So tying it all together, this is what you want to do. Analyze your current situation. And part of a membership is to help you select suitable investment, set realistic expectation of performance, and then monitor your portfolio and recommend changes over time. So this is this is what you want to do, going through the 4 steps that I've shown, but also part of Investing 101. We learn about analyzing your current risk tolerance, your current personality, your current goals, what type of objectives you have, and then we looked at the different types of investments, and hopefully you have a better idea of what is right for you. Set realistic expectations. This means the risk and return. If you are somebody that wants low risk, right, then the realistic expectation is that you're not going to get the highest return because you're going to exchange that risk for return, right? So that's one of the realistic expectations. And also, if you go for a high return, make sure that if you lose some money in the market, you have time to make it back up. Monitor your portfolio. We talked about asset allocation, rebalancing. If you didn't rebalance on a regular basis, you end up losing out more money in the long run potentially, and you want to monitor it, make sure that the portfolio matches you. When your goals change, your portfolio will change as well. Hey, stay tuned for more exclusive member videos and products. This is a membership. It's monthly. I started this using a lot of the stuff that I've used to help many people with their finances, and what I plan on doing is that every week and month just adding more and more, and it's going to get better and better. I'm super excited. I hope you are, because I really want to help you, and I really feel confident that you can become financially independent, financially free, and build wealth. Thanks so much, and I'll talk to you soon. Look forward to working with you. Aloha.